the big question, right? Is AI the next stock bubble? And this is literally a $1 trillion question. This is literally a $1 trillion question. Let's make a delineation here. Let's take a second. Investing in AI is different than investing with AI. Both are opportunities to gain from the technology, but in very different ways. Numerous companies have benefited substantially from including AI into their operations, for instance. OpenAI, as a result of this AI boom, is the highest value private AI company in the world. Again, for those that don't know me, my name is Nick DeAmgelo. I'll be your host today. I'm president at Saint Investment Group here. And for those that don't know, Saint Investment Group, what we do is fixed income. We specialize in fixed income. Our fund is focused entirely on fixed income. We have over 600 mortgages in 29 states and growing, over 200 million in assets under management. Our fund pays returns from 12 all the way up to 14.28% returns. And we've never missed a distribution. And that's been for over a decade. So we always like to say always on time, every time. We always like to include this slide. This is a brag slide. I want to be very open and transparent. Just a little bit about what our team's achieved. We have an amazing team, amazing asset management, and we've created some amazing results for our investors, most importantly. So again, over 200 million in asset under management, over 131 months of consecutive happy investors, over 14 million distributed to these amazing investors. And James from Villa Park, hello, down the street, not too far. But most importantly, don't take my word for how great we are, although I do think we're very great. I have a bias. I encourage you guys, I always encourage you guys to check out what investors have to say about us. We're very visible online. We're all over the place. And we have, 50 plus reviews from happy investors that have had great experience with us. So check out Trustpilot, check out Google, all over the place. We have reviews that will help you guys understand more about us from third parties, people that have worked with us in the past. But don't take my word for it. Here are some great people that we have great relationships with. Richard Fong, Clint Lawrence, Billy Kim, all amazing individuals, but check out our reviews online as well. And before we get too far, I wanted to take a moment and introduce you guys to a very important member of the Saint team, Mr. Tom Furlong, who is our Director of Investor Success. So Tom, can you hop up and tell the audience what you do with Saint and how you can help them out?
Absolutely. Yeah, thanks, Nick. As Nick mentioned, my name is Tom Furlong. I am the Director of Investor Success. What that means is your investment experience is something that I'm here to help with. So Nick's going to go through tonight on everything AI, all the information that he is just so well equipped to go through. And then I will go through the income fund. So if we have any questions or you want to have a specific one-on-one conversation about the income fund, we can set up a time. I'll put up my calendar link and I'll put my phone number in the chat right now. So feel free to just schedule a time with me that works for you, or you can text or call at your convenience.
Tom, really appreciate you. Yeah, if you could, perfect. Got your info in the chat. So guys, Tom is an amazing resource for you. I highly recommend that you guys get connected with him. He's worked with hundreds of millions of dollars in investment. He's seen nearly every type of portfolio, every type of interest, and knows what he can do to provide the best information and support for y'all. So a few ways you can get in touch with Tom. You can call him directly throughout this presentation. If you want to talk to Tom now, you can get on the phone with him and you guys can chat. Or if you want to book a call with Tom for a later date, his calendar link is in the chat. And you can book a call to go through information with Tom and he can help you out. So with that said, thank you, Tom. And we will get rolling here. So a quick outline of what we're going to be handling today. We will start with a quick legal disclaimer and keep our attorneys happy. Then we will be jumping into the topic, AI and investing. We'll be jumping in, covering a lot of great information there. We'll round out with some housekeeping, and we are going to end with live Q&A. where we can chat together. So get your questions ready. You can also be dropping questions throughout this webinar if something comes top of mind while we're going through some information. But a quick word from legal. Let's keep them happy. I encourage you guys to read this slide, but here are the highlights. One, this is not investment advice, and this is for educational purposes only. All investments carry risk. Past performance does not ensure future results. And then also, I'm going to be talking about a lot of numbers throughout the presentation today. A lot of times I'm going to be talking off the cuff, maybe things from memory, etc. So please verify these numbers. Don't take my word for it. I encourage you guys to do your own research and dig in. And last but not least, before we jump in, one of my favorite things that we do in webinars, we always want to give you guys the opportunity for a nice little gift from us at the Saint team. So we started a book giveaway. This is a book that we're reading and discussing as a team, something that gives new insights to the topics that we're going through on our webinars. So this month's book is called Coming Into View by Joseph Davis. Okay, so why this book? Why do we want to give away this book? So the author is Vanguard's global chief economist and head of its investment strategy group. So Joe Davis is a powerful name in finance with a ton of insights along the way. So we want to give you this book that covers not just AI, but the future of AI with the tug of war, with our fiscal deficits, with the debt that we have as a country that overlaps with the dollar, et cetera. It's a very, very interesting read. We cannot encourage you to take a look enough. But the big question is, how do you get this book? How can we give you this book? First off, if you don't want to wait, you can always scan the code there and go to Amazon. We don't make any money from it or anything. We just want you to have access to it. John, I got your question. There is a link. If you scan that QR code with your phone, you can pull that book right up and buy that straight away. But if you wanted to win the book for free, John, I have good news for you. We want to hear from you guys. So engagement is key here. If you guys engage, we want to get you a book. Here are the ways to engage. Comments, questions, etc. in the chat. The chat will be our hub for all of us to get to connect today. So you can drop things in the chat along the way and we can have good discussions. If I'm not able to get to your question in real time, then we'll save those and we'll go through those at the live Q&A at the end. You can also engage by responding to polls and also leaving us a review on Trustpilot. So between those avenues, lots of ways to win a book. For the best engagers today, for the best contributors today, we're going to be sending out books. We don't have a set number. It's for whoever kicks butt and whoever the biggest contributors are. We send these books out. So I encourage you guys to jump in. We want to hear from you along the way. But let's kick things off. Let's talk about AI and investing. Let's start off with a powerful stat. Last year, 90% of the world's data was created in just 12 months. 90% of the world's data was created in just 12 months. Think about that for a minute, because it illustrates the exponential growth of information that in the world that we live in today. This is digital transactions. This is sensor data, social media, connected devices, etc. It's a mountain of data that we're seeing, and it's growing exponentially. The investment sector is flooded by data today, if you didn't know already. Without the proper tools to analyze and digest and to get insights from this data, people will be left behind in the new world that we're going into now. So to take advantage of AI in today's world, leaders aren't just adding it to their existing workflows. They're starting with it as a starting point for many processes. So rather than using AI to validate human instincts and confirm gut feelings, which was very common for many years in finance, now we're seeing companies, including Saint, rely on AI systems to find, analyze, and act on data that gives them the competitive advantage over other competitive investors that are relying on traditional methods or ways of the past. AI leadership, not just AI adoption, is rapidly becoming the dividing line between market leaders and market laggards in the investing world. So we're going to take a look at investing as a whole, and then we're going to focus on real estate investing specifically and how AI is impacting those worlds. But before we get too far, let's take a minute here. Let's back up. We know that AI is a huge headline today. We know that it's all over the place, but is AI actually new? Is it really as brand new as it feels in a lot of the media? Or has it been around a long time and it's a process that it's taken to get to the point it's at today? So let's take a quick look at the history of AI so that we can understand it better. Each of the last 6 decades has seen major and foundational progress in what we call AI today. Bayesian statistics are a branch of probability theory. Big word, lots of big words in that. But here's the takeaway. Expert systems that were founded in the 1980s were an early form of what AI sought to mimic human expertise by providing the computer programs and a knowledge base and a set of rules. So like if-then sequences, for instance, to solve complex problems at that time. So examples from that era include XCon, which was successful in creating computer system configurations. And then this one's really interesting. It's called MySyn, which was a medical system for diagnosing infection. So now we're seeing meaningful applications, things that are using AI models as early as the 60s, and we're seeing AI applied to specific complex data industries like computer coding and medical fields, right? Then the 1990s roll around. They brought in early machine learning algorithms. This is the beginning of machine learning, especially as it relates to the investment world. We saw this advance throughout the 2000s. We also saw more sophisticated online banking platforms in the 2000s. And now we're seeing a big change in how consumers are managing their money with all these AI tools along the way. So the big question is, now that we understand a little bit of background, who is winning the AI race in investment management today? So we know across the board that AI is making a huge contribution throughout the markets, but it's especially noticeable in the investment world. What they're really using it for at large scale, initially at least, was investor communication. So these are new developments that are giving real-time access to portfolio performance. We're seeing personalized communications, on-demand Q&A interactions in these platforms. A notable achievement, the first note here is BlackRock. BlackRock was able to achieve an additional 2.5 trillion in assets without hiring more staff and also while increasing their investment returns. So a massive increase in their portfolio without more staff, without a bigger headcount, and also while improving returns for investors. So how did they do that? Their AI-focused technologies has their division of AI-focused technologies has generated over 4.5 billion in annual revenue on its own. So they use a few platforms internally. They call it Aladdin, that's used by many big firms like Royal London Asset Management and many others. But that alone is generating them 4.5 billion. So it's catching on quite a bit. At JP Morgan Chase, for instance, AI is embedded in client services, risk management, fraud monitoring, et cetera. So they're using it heavily. And then I'll just say as a side note here that we're also seeing a ton of this in the mortgage industry. So for simpler applications, AI is being used to process loans and support underwriters in a massive way. This is helping underwriters significantly in their due diligence process. Now, there's upside and downside here, right? The upside potential that we're seeing in the mortgage space specifically is faster loan underwriting timelines, which if you've ever been through this process of being underwritten to buy a home and get a loan for that home, you know it's a freaking nightmare, right? It often has multiple requests for random documents, even if you've submitted every single item on their needs list from the beginning. So this type of AI improvement is a massive upgrade for the consumer. That's a positive thing. The downside potential here, especially for the mortgage industry as an example, is you can start to see homogeneous loans. That's the expectation, is that if there's loans that fall outside this narrow window, or you have complicated tax returns or income structures. For instance, I invest in a bunch of real estate, so it makes it more complex for underwriting. Chris, underwriting can be a bad word. Yeah, it can be a huge headache for sure. But Here's the bet, and here's what we expect to see using the mortgage industry as an example. We expect to see that we'll see more specialized roles in industries, where, for example, you might have one underwriter handling the cookie cutter mortgages with an AI assistant, and then maybe a more hands-on underwriter who has the role of underwriting more complicated files with a more human touch. Okay. Right there, I'm going to give you guys a little hint. Hint, 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 right? We're going to go into that later. But to keep it moving and cover a couple others, Morgan Stanley's using AI and generative models for wealth management, portfolio optimization, client communication, etc. Goldman Sachs, AI-powered algorithmic trading desk for hyper-personalized client recommendations. Their trading desk at Goldman Sachs saw their AI platform seeing a 27% increase in intraday trades profitability while using AI-supported commodity strategies. This outperformed their human-only desks. So this is big. We're now starting to see that AI in certain applications is outperforming their human trade desks. So not everyone can be a winner, right? What do some of the big named losers look like that are utilizing AI, and what experiences are they having? Bridgewater. Let's talk Bridgewater, for instance. Bridgewater was a pioneer in systems-based investing, using expert systems and computerized algorithms to identify opportunities and manage their risk in their portfolio. So you've probably heard of their famous or their infamous founder, Ray Dalio. Dalio was one of the first and largest examples of integrating AI into his fund's core strategy. The note here is that Bridgewater actually has a mixed record historically. So for many years, Bridgewater didn't even beat the S&P 500. So using Bridgewater as a core example here, AI actually produced worse results than the market for many years. And this is noteworthy because Dalio's approach was so revolutionary at the time, but it had such mixed results in the end that it showed a lot of potential flaws in AI investing. So Dalio has underperformed the S&P 500 and NASDAQ by quite a bit for the last 15 years or so. So the question comes, is his AI model just not competitive? Or does AI still have major limitations and it's not up to speed with a lot of pieces of the market? The reality in Bridgewater's case specifically is it appears to be both. So let's dig into that a little bit. Let's see where the train fell off the tracks for Bridgewater as a case study. So Bridgewater's evolved AI strategy is built on AI first, is what they call it. They lean on this to evaluate data, to create new market forecasts, and to make trading decisions. Bridgewater's process cross-checks outcomes against historical market results and adjusts the algorithms to fix flaws. So according to Forbes, this is a big name here. According to Forbes, the former Fed chair Paul Volcker, very famous, has described Bridgewater as developing more relevant statistics and analyses than even the Federal Reserve. Okay, so that's a huge, huge, huge vote of confidence from Paul Volcker, a former Fed chair. That said, we know that they have underperformed market indices. So even if they have more advanced analysis than the freaking Federal Reserve, how does that benefit them? Does that benefit them? Historically, on this case study, the answer appears to be no. One of the ongoing questions of AI is, when is an investment approach too complex? And while there are way too many variables to cover by any single platform involved, that's the goal of AI, especially for Bridgewater. So you look at a lot of these groups, they're trying to dogpile information into their systems to analyze it at scale. So if if a firm is investing in everything, like Bridgewater invests in a ton across the board, sure, they can weight their investments, they can, use massive amounts of data, but does this actually make their investment thesis so complicated that they then no longer have an engine that is able to be broken down and improved easily? That's one major question that AI has not answered yet. So let's take Saint for an example. We see overcomplication as a major risk. We like simplified, investment theses. If you invest in everything, for instance, you're basically not saying no to anything. You're saying that everything's on the table. And that has its own risks as well. So when we say that we believe single family housing is has the most opportunity in real estate today, especially due to a supply shortfall of 6 million homes or so. Hold on, let me check. Can everyone see my cursor here? I just want to make sure video is all good.
Yes,
You
we
can
can.
see my Okay, cursor's good. Okay, cool. John, appreciate it. Ange, appreciate it. Ryan, appreciate it. So that said, simplification and directing AI is more important than ever. That's a human element, right? Because what if an investment group was making bets on, let's say, 30 different industries in 25 countries? At some point, those data points would break down and key information would be missed somewhere. So simplification here is really the key to a lot of these investing strategies that we're starting to see emerge. That means humans need to be the ones simplifying the focus and identifying what the most important points are, and then identifying and analyzing those variables with AI. That's what we're consistently seeing with many of the top performing groups. Also, according to NVIDIA's 2025 State of AI and Financial Services report, approximately 70% of respondents say that AI has generated revenues to increase of over 5% for these companies, with a dramatic rise in industry-specific companies reporting a 10 to 20% revenue boost after deploying technology. So focus seems to be a differentiator here. Who's winning and who isn't? Right now, it seems to be focus. Here's an interesting application that we're also starting to see emerge in AI. We're starting to see robo-advisors being much more widespread throughout the finance world. Anyone who has been in a large company knows that anyone that's been in a large company that requires a lot of customer service knows that probably 90% of requests are common and consistent and literally have scripted answers. So this is something that AI is fantastic at, right? Excuse me. So companies are leaning into this with the fact that they can script a lot of it. They know the common answers that they're getting, or the common questions that they're getting, and they can build in automated responses with up-to-date data, right? So if you look at companies like, let's say, Amazon, one of the biggest critiques and critical assessments of Amazon is the fact that you can't freaking talk to anybody, right? So what a lot of critics have said about Amazon is that the higher end purchases, the most expensive purchases on Amazon, for instance, are not being completed on Amazon any longer. A lot of people are going to other routes, whereas something like Apple, even if they're not exactly a tech innovator at this stage of the market, you can pop into a store, you can talk to a human, and you can get some help on the phone. They typically have some degree of phone service by a real human. So big finance and investment firms are taking this same approach, and they're making sure that they can cover 90% of the questions with scripted AI that provides a ton of support and a ton of updates along the way, while still having the opportunity to speak to an advisor on the back end. So this is an interesting boom along the way. Robo-advisors also give you the opportunity as an investor to choose if you want to go exclusively with a robo-advisor. And the good part here for consumers is the fee model with robo-advisors is much reduced. So it's not as expensive as having a traditional advisor where they take a chunk of your AUMs every year, or they have fixed fees, et cetera. And the best part is it's transparent, right? So the consumer knows they are the ones making the decision of who they're going to be speaking with, and they know the resultant fees on the back end of that. So that said, it's an interesting trend, and it's putting the choice in the consumer's hands. So it's adding a lot of value on the consumer end. So that said, what are the risks in the market today? We have a pretty good list here that we see as the top risks of using AI in the investing world. data quality, overfitting, black box vulnerability, unintentional discrimination, herd behavior, et cetera, et cetera. We'll go through some of the top ones here. Number one is going to be input quality, the data quality. This is crucial for AI. AI investment models are very sensitive to the quality of inputs. The relevance, the objectivity of the data is what produces a good or bad result on the output. So if input data is biased one way or another, or incomplete, the results will not be as accurate as they could have been, or even flat out completely wrong, right? Similarly, neutrality. The question is, can AI have a bias if it's a computer system, if it's, a technology? The answer is absolutely. AI can definitely have a bias, right? Let's say you train AI on sources that have underlying biases. Yeah, John, garbage in, garbage out. Exactly right. Let's say you train the AI bot on sources that have underlying biases. The AI will replicate these biases. And because we know all humans have biases, AI data sets can also have these same problems passed along their analysis along the way. We'll jump into herd behavior. Herd behavior. If everyone jumps off a bridge, should you jump also, right? If everyone invests in Enron, should you invest also? We kind of know the answers to those. We really are clear on those outcomes. But what if AI misinterprets trends or momentum in the investment markets for a good investment outlook instead of just a short-term bubble, for instance? We know that the herd mentality is often not based on common sense when you peel back the layers. But that basic common sense might be missed by AI going through the processing, whereas it might need a human component to help sort through some of those pieces. We're also seeing this is one that's very personal to me that I see in the market quite a bit. AI washing. AI washing. What that term means is it's a concern that organizations are now overstating their use of AI in their operations. The net result is if companies exaggerate their involvement of their level of AI, consumers are misled and may come to believe that a company will be worth more than it likely will be, right? This is the number one fear around an AI bubble. That if every company is now saying that they're an AI first company, but with so many reporting that AI is actually not making a major impact for them, we have a complicated outlook where buzzwords are boosting share prices more than the value of the company in many cases. And then the last one that will lean all the way in on, cyber attacks. If AI is sourcing data from the web, and the web is essentially pretty relatively open source where anyone can post anything to a lot of different places, what's to stop AI from taking nonsense data and nonsense opinions and integrating it? What's to stop, let's say, a hacker from getting into the AI source code and altering it meaningfully? Reddit is a good example here. Reddit is a massive discussion board. Millions of people get together, they discuss infinite topics, right? But we also know that Reddit is a major source that many of the biggest AI models use to find their information. And we also know that statistically, this is a big one. We know that statistically, Reddit has an estimated 70 to 90% of users are actually bots. Okay. So if AI is pulling Reddit as a major source, and up to 90% of Reddit users are bots that are pushing agendas and discussions that are not even human based, this is a major source of risk for AI models. What would stop hackers from, say, creating thousands of bots, unleashing them on Reddit, and that information is now being used as a reliable source for AI models? Well, the bad news is we know that's already happening. So a lot of AI has major risks associated with bad information and bad logic just based on where they get their data from. So we'll lean into the ethics behind this. One thing I want to put in your brain, who here knows what the Turing test is? Can you drop in the chat if you know what the Turing test is? Okay. The Turing test. This is a big one. The Turing test was created by renowned mathematician and codebreaker Alan Turing to test whether a computer or a program can think like a human. The end result would be if this computer or program could pass as a human to another human. So a computer convincing a human that it's actually a human. The test includes the core test that Alan Turing designed was that a human would be asking questions on one end to a human participant and on one end to a computer participant. But the human asking the questions would not know which is which. If the human interrogator cannot correctly determine which one's human and which one's a computer, then the computer has passed the Turing test. Anthony, that's exactly right. This year, keep that in mind. This year, OpenAI's ChatGPT 4.5 model was deemed to be human 73% of the time when it was instructed to adopt a human persona. So if you gave ChatGPT 4.5 the prompt that it needs to pretend to be a human, then it would convince a human 73% of the time that it was actually a human. The impacts of this are massive. Okay. So the impacts of this are massive. So when we ask questions like, why are younger generations speaking to AI with so many personal questions and asking for so much personal advice? One of the big reasons is because AI is becoming and feeling more human as it progresses. And it actually knows how to mimic human interactions better 73% of the time than a human. There are a ton of regulatory concerns on this topic. So the ethics, the trust, these get complicated now that AI is getting so advanced. This has implication in a ton of industries as well as we apply this to the business sector. But for finance and investing, which is the focus today, this year the SEC is targeting concerns over fiduciary duty to make sure that investment firms that are using AI have guardrails in place to validate their obligations to clients, especially with things like potential conflicts of interests, the illiquidity of investments, complex investment options, etc. These rules will also address transparency and disclosure for black box models, meaning companies will now have to explain how their AI works to their investors. I think this is largely fantastic. So the SEC and any government regulatory body can have ways of taking something great and making it not so great, but I'm optimistic that the SEC leaning into AI will have some good solutions on the back end. So the big question, right? Is AI the next stock bubble? And this is literally $1 trillion question. This is literally $1 trillion question. Let's make a delineation here. Let's take a second. Investing in AI is different than investing with AI. Both are opportunities to gain from the technology, but in very different ways. Numerous companies have benefited substantially from including AI into their operations, for instance. OpenAI, as a result of this AI boom, is the highest value private AI company in the world. Now you look at a different application. You take Palantir, for instance. Most people don't even know what Palantir does, right? It's a black box of its own. But Palantir has two platforms. They have an artificial intelligence platform and a data operations platform. And these solve mission critical problems for government and commercial clients using advanced machine learning and large language models. So they take something like what ChatGPT is doing, but they process this and they apply this to things like companies and governments in a way that's secure. So that data is not public, it's internal, and it's really more of a protected sphere so that they can work through their processes in a secure environment. Palantir's revenue soared this year, and the stock price has more than doubled due to the value of its AI-powered solutions to both, business communities and government customers. Their customers include the State Department, American Airlines, British Petroleum, Credit Suisse, et cetera, et cetera. So let's take a minute to note that these are the big names with the biggest AI headlines because of their size and their brand awareness. The companies on this board, NVIDIA, Microsoft, Alphabet, AWS, basically Amazon, Meta, Palantir, et cetera. But what about overall AUI, excuse me. What about the overall AI usage by the average companies or the mid-sized companies? Let's see how they're faring in the AI world. So we saw the big names, but what does the general business community see applying AI? Well, it's not as positive in many cases. Recent studies like the MIT study show that between 80 to 95% of companies do not see a meaningful benefit from AI. Whoa, big numbers, right? These are serious numbers. But like all data, let's ask the big question of why that is. So when they ask the leadership in these companies, the leadership is clearly saying that it's because they believe that the employees in the company don't want to integrate or adopt AI as part of their processes. So if you look at that at face value, it would be a classic example of employees fighting the adoption of new technologies. The internet, printing press, email, et cetera, they all had integration issues with different companies along the way. I mean, in my personal experience, when I first started in real estate, I had to sit down with one of our earliest partners and explain that we needed a tech overhaul. We needed to move from his BlackBerry and AOL and literally a yellow pad of paper to switch over to the iPhone, Gmail, and Word documents. And this was a big deal for a successful guy to make such a massive shift, right? It was the right move then, and he's still a friend and mentor and someone I'm very close with. But think about what that process looked like for this individual. The previous CEO of a Fortune 500 public company who's driving a Bentley around as his daily driver, having to make such a massive shift and integrate technology. So maybe the corporate leaders have a point here, right? That adoption is hard, but it might be very necessary. But to understand this question, we got to understand what the employees also have to say, those on the other end of the spectrum. So what did the employees have to say? What they noted, what the employees noted in these studies, were that AI did have some help. It did offer them help and have many advantages when they used it at times. But they also reported that oftentimes it took more time to use than it actually saved them. So the benefits were not universal in many industries or roles within most companies. Some found benefits, others found it was a net negative. Many also reported that the integration of AI into daily tasks was burdensome or flat out untrustworthy. This study had AI integrated into calendars, emails, notes, and other normal daily company activities. But many employees reported that concerns that AI was constantly looking over their shoulder, it was looking at their performance, and they started feeding it inaccurate data or information that instead of improved the AI, it was meant for the employees to be evaluated more positively by the AI that was looking over their shoulder. So that's one of the dark things that we're seeing emerge with that interaction of humans and AI. But in the end, the employees didn't find, in the end, those that didn't find the AI trustworthy, in the end, that those that didn't find the AI helpful didn't trust the AI. They didn't find it helpful in the time it took to utilize it, and the AI had worse results over time. It actually became less accurate and less valuable statistically over time, not just them complaining about it. So no wonder why they stopped using it, right? In the end, the biggest question is, will AI be helpful over the long term in the business community? And you can blame the employees or the company leadership or the AI tool that they used itself. But at the end of the day, if it doesn't work, it's not valuable in a competitive business environment. And 80 to 95% of companies are seeing that they're not getting the massive benefits that they expected. So again, I'll note that these were companies across the board. This was not just in the finance world. We already saw some success that many finance companies have had using AI. But is there a bubble? That's the other half of the question here. OpenAI, aka ChatGPT, the CEO, Sam Altman, is openly saying that he has concerns about an AI bubble, saying that investors are overexcited about AI and, quote, someone is going to lose a phenomenal amount of money. We don't know who, but also a lot of people will make a phenomenal amount of money. So he recognizes that there will be massive winners and massive losers in the AI world. On the other hand, we see that the Magnificent Seven companies are driving the AI boom and are not speculative companies. These are established, mature companies. So as these AI leaders, powerhouses like Apple, Microsoft, Alphabet, et cetera, as they find the use cases and the best opportunities to apply AI to customers, The reality is we'll probably have some pretty good outcomes on the back end of that. So what projections do we at Saint have for AI in the investment world? Here are some interesting ones. Number one, AI natives, meaning firms that are built around using AI technology, will outperform. Groups that are putting AI to the core of strategies and leaning into it heavily. Two, AI will continue to advance automation in investing. This is particularly important in things like customer service, use of AI agents, et cetera, getting better customer service to investors along the way. We will also likely see legacy institutions that will accelerate their acquisition of AI talent, infrastructure, and capability, meaning they're going to be gobbling up those top minds in the AI space. We're already seeing that. We're already seeing that Meta is willing to pay, $100 million as bonuses to these individuals to get them on the Meta team. So we're likely going to continue to see that the large institutions will be gobbling up that AI talent. We'll probably likely see regulatory oversight increasing over time, focusing on transparency, risk controls, ethical use, data privacy, etc. And also, we'll likely see investment firms thriving that build consistent, explainable, and well-governed AI systems. Models that are focused on understandable, models that are on understandable strategies, models that have a purpose, models that have solid data foundations. So, and last, we believe that the top tier performers in the AI world will have checks and balances confirmed by humans, meaning AI, with its massive abilities to digest huge amounts of data, will integrate humans in a major way to make sure that things like accuracy and common sense are included in those processes. So, what are the most compelling applications of AI in real estate specifically? So imagine analyzing every lease, every tenant, every property, every risk in a potential market, and doing all that before lunch. That's the power of AI when you apply it to something like real estate. The amount of research capability allows us to massively improve our abilities and access different markets and different market data at rapid time. So things like deal sourcing and due diligence, these are highly labor intensive. AI algorithms, on the other hand, can support and analyze huge quantities of data, looking for opportunities that maybe even the human component would miss. A unique advantage of using AI for deal sourcing, for instance, is the unique ability to combine multiple different sources. Think outside the box on this one. Social media, financial news, academic reviews, right? Taking these multiple sources and looking for new ideas or new strategies. So let's use that as an example. The ones we stated: social media, financial news, academic reviews. Think less about cute posts in nature and think more about how many posts a day people are making at restaurants in a downtown area. So if you take that number versus, let's say, a population, you can see how active people are in that downtown area and what the local culture is like. So are people going out and eating dinner, or are they actually doing those hikes? Are they going to the movies? These are insights that are available now with AI that would have taken infinite man hours in the past. The speed with which AI can crunch data points like these contributes to faster due diligence, faster decision-making, and overall a more efficient process at large scale. We also have risk management scenarios, right? Consider the volatility of the markets. Consider supply chain disruptions. Consider geopolitical conflicts, economic downturns, etc. Overlaying those with investment thesis is incredibly interesting for the future of investing. AI is fundamentally changing how commercial real estate, for instance, how portfolios are sourced, how they're valued, how they're managed, with capabilities spanning from automated underwriting, predictive maintenance, dynamic portfolio optimization, etc. Very, very interesting. Let's talk about a downside, though. We've also seen this go the other way, right? One group I have in mind ran data, and they're very early to this space using and applying AI to acquisitions. They applied AI to 50 markets in the United States and tried to predict which markets would be best for growth of a real estate portfolio. They were right on a 2-year basis. On a 2-year time horizon, they crushed it, but they were dead wrong on a 5-year time horizon, which, as we know, is the normal time for syndications and many real estate deals. So the question is, what did they do wrong? What they did was they found small markets that were outperforming averages, right? What they did was assume that those metrics would continue. They also had massive property management headaches, for instance, because the best property managers and the best property management companies don't work in small markets. So they were dealing with worse operations to back up their investment thesis. They only looked at the data and they didn't have the experience in actual practical real estate asset management. And now they have big problems by misusing AI and misinterpreting what results the AI gave them. They thought that because they were data analysts, that it was an easy transition to becoming real estate operators. So maybe a flaw in logic there a little bit as well. Real estate professionals should prioritize the advanced data analysis for sure. Let's be clear on that. But they also should be incorporating this data with industry experience to make sure that business plans make sense from all angles and most of all have common sense, which only really someone with a lot of experience can have. At the end of the day, it's not the AI that is the future. It's the tools within the AI world with human experience that make AI a powerful opportunity for real estate companies and investors. So this is one of the most common questions we get. This is actually one of the sources for this webinar. How is Saint using AI? So we'll give you guys a little case study and help you guys understand how we're applying AI to Saint. We've covered a lot here, but one of the most interesting things that we're seeing at Saint that's been revolutionary with AI is due diligence. More deals, faster deals, more accurate analysis, projections, double checking human work, human errors. This allows us to increase the speed and accuracy that we are underwriting opportunities. So we're able to look at more deals overall because we can underwrite them faster. And when we double check a market, what used to take us hours can be answered in really minutes with one well-placed AI prompt. So we're checking things like economic growth, population growth, disposable income, crime rates, projections on the future of that market, et cetera, et cetera, et cetera. All of this data is already available. So it's not revolutionary that we're checking this. What's revolutionary is that it takes a freaking long time to do all this research from all the different various sources. With AI, we can do this in minutes and we can compare and contrast deals with a ton more efficiency. And if we can process more opportunities, we can also compare more opportunities and find the best of the best to invest in. So due diligence isn't just about making sure that we're getting a good deal. It's about the fact that we can process many more deals and find the best of the best. This actually impacts acquisitions and returns on the back end is what we expect to be the outcome. Next, we have market data. We kind of covered it a little bit, but collecting data from a wide range of sources in a fraction of the time. That's the core here. So what about the expanded market, for instance? What about the local, the county, the state data? How did this city or county or state do in the last recession? Are the industries in this market recession proof, like manufacturing businesses? Or do they get crushed in down markets, things like tourism? How does this market compare to other markets in the US? Again, this data is all available. It's just hard to compile quickly and easily. But with AI, it allows us to organize and sort extremely quickly what would have taken us many hours on the back end. Then we're talking about efficiencies. A lot of these are operational improvements, using AI to handle routine tasks to improve reporting. This is a big one. Leaning into the efficiencies that it creates within the business, right? For instance, how does our return hurdle on investments correlate to our company's operating costs? How do we compare to industry standards with various metrics? How do we continue to minimize risks along the way? What markets have we shown to be the lowest risks for our portfolio? How much time do different mortgages, for instance, take up of team time and team resources? How can we allocate team time better to the best opportunities in the market? These are all systems that we're building out and analyzing now. And, literally, AI is giving us that opportunity to really drill down on efficiencies across the board. And then I'll give you guys a little look into the future. Some things we're looking at around the corner here. What I would love to see and what we're exploring now, rate cuts or rate decreases and the likelihood behind these in the future. I would love to get some projection on that. So we're looking into that very heavily. Economic data projections and their impacts. How does immigration affect investing? How do tariff wars impact investing? If we want to go real crazy and overlay all kinds of crazy questions, how does China's population implosion impact the US dollar and inflation expectations in the US? Right? Now we're getting real deep in the data. The truth is, we have answers to a lot of these. But with AI, we can chart and track these answers more effectively. So the complexity that we can digest multiplies when we overlay AI, good questions, and good human interaction on that. So with that said, the reason that we drill down into these webinars, the reason that we choose the topics that we do is one objective: building resilience in your portfolio. It's to give you guys the tools and understanding of what's going on in the market to create what we like to call an all-weather portfolio. That's really our end goal. So what we see as the biggest opportunities in the market, obviously we're very pro real estate. Obviously we're very bullish on the opportunities in real estate, and AI actually multiplies that optimism and what we're seeing as opportunities. In today's market, we see fixed income as the best opportunity, to be very clear. So let's say you were looking at something like an income fund. If you're going to be looking at fixed income, sure, you could go the bond route. Sure, you could take your 4% and enjoy that. And if that's where you're at and you're okay with inflation being at 3%, then that might be a good opportunity for you. Most of our investors, the vast majority of our investors, are looking for something with a bigger meat, with a more meat on the bone from inflation, for instance, because they believe it reduces risk. The number one opportunity that we're seeing in the fixed income space with all the data, with all the data points, with everything we're looking at, is single family mortgages. Why? Because especially in environments like we're looking at today, where the biggest trends, the biggest discussions in finance are constantly revolving around what is Jerome Powell going to do, we love the all-weather component of single-family mortgages. For instance, if rates go up, no problem. Mortgages are more stable. We see less refinances in the portfolio. Cash flow is more stabilized. There's less turnover overall. So asset management is actually much more streamlined. On the reverse, this is what we're seeing today. What if rates go down? Well, that's great too. That stimulates buying. Again, we saw it at the beginning. 30% increase in mortgage applications. That's fantastic. We love seeing a moving market. It also stimulates investment. It boosts returns on our side because what we owe or what we own goes up. They're less likely to foreclose. They're less likely to have defaults because they're having record equity already in their properties. And that's only going up when more people are buying and bidding up properties. So that's our biggest takeaway on what we're seeing in the market today. If you want to learn more about what we're investing in, and what we're seeing in the market and what we're targeting, then I highly encourage you guys to get with Tom and learn more about our investment, our fixed income fund, the Saint Income Fund. So I see Tom popping in. Tom, you want to say anything on the fund side? You want to jump in for a few minutes and give people a little more info on that?
Yeah, a couple things that I mean, you did a great job. Going through the AI aspect, which is just fantastic, and then going through on the income fund specifically, exactly as you mentioned. We just saw rate cuts, 25 bips. We love that. We didn't mind it where it was either. And so we would consider ourselves agnostic, not only to the interest rate, but really location as well. There's a reason we're in 29 states. We focus on suburb locations. We want to spread out the risk and have it diversified. And so that's one of the main criteria that we're looking for as well. But there's a reason that we have the income fund. There's a reason that we have 600 mortgages across 29 states. And it all leads into the same exact idea of protection of principal and then the stability of the cash flow.
Exactly right. Exactly right. And so, and if you guys want to know how we analyze investments, I saw a couple questions in here that are really solid. I'm happy to dive into them on Q&A. But if you guys want a significant breakdown of what we're doing, I would recommend you check out two webinars from us. One is the housing market webinar we just did. What's it? The Great Housing Crunch, right? The housing squeeze, excuse me. We just did that last month. That is a market breakdown of what we're seeing in the single family space. 6 million home shortfall in the single family home market, a remarkable amount of data. Over 80% of single family mortgages are owned, guaranteed, or insured by the US government at some point in their life cycle. Insane. Right? So I encourage you guys to find all the data points, tons of breakdown there. And if you want to know how we're doing due diligence today at Saint, we have an entire webinar on that. It's called the Mortgage Investing Masterclass. So I recommend you guys check those out if you want more information. I think Tom was dead on.
And that masterclass, I'm happy to send it out. Just reach out to me. I'm happy to send you both of those.
Yeah, Tom has access to those easily. So I would definitely ping Tom and get those. And then also to on the tail end of what I just said on our webinar side, we have all these compiled for you guys on YouTube. So Tom will have the easy links and I'll have a lot of other resources for you. I encourage you guys to get with Tom, but we also have a ton of breakdowns, a ton of deep dives, just like this one on markets from the US dollar, covering the future of the US dollar, to covering the stock market and some major issues we're seeing on that side. All these are on YouTube.